It's been an interesting week with a number of releases and events swinging the markets, and as it is about to end, we have a look at what next week has in store for the markets. On the monetary front, we note RBA's interest rate decision on Tuesday, while we also note the interest rate decisions of Canada's BOC on Wednesday and Japan's BOJ in Friday's Asian session. Also, on a monetary level, we highlight the testimony of Fed Chairman Jerome Powell before the Senate on Tuesday. As for financial releases, we would note on Monday the release of Switzerland's CPI rate for February, Eurozone Sendex index for March, and the US factory orders growth rate for January. On Tuesday, we get Australia's and China's trade data for January and February respectively, and Germany's industrial orders growth rate for January. On Wednesday, we make a start with Japan's current account balance for January, Germany's industrial output for the same month, Eurozone's revised GDP rate for Q4, and Canada's trade data for January. On Thursday, we note the release of Japan's revised GDP rate for Q4, China's inflation metrics for February, Sweden's GDP rate for January, and the US weekly initial jobless claims figure. On Friday, we get the UK's GDP and manufacturing output growth rates for January, Norway's CPI rates for February, the Czech Republic's CPI rates for the same month, Canada's employment data for February, and highlight the release of the US employment report for February with its NFP figure. The USD ended February high against counterparts, yet seems to edge lower for the week, ending a winning streak of 5 consecutive weeks in the greens. On a monetary level, the market worries about the Fed's hawkish intentions seem to remain ever present, and we note that Fed policymakers maintained their hawkish tone over the week. On a macroeconomic level, we highlight the acceleration of January's core PCE price index growth rate, which exactly underscored the persistent inflationary pressures in the US economy. On the production side, we note that the ISM manufacturing PMI figure improved for the month of February, yet remained below the reading of 50, implying a continuous 4-month contraction of economic activity for the US manufacturing sector. On the demand side of the US economy, we note the more pessimistic outlook on behalf of the average US consumer, as implied by February's consumer confidence indicator. Overall, the financial data tend to maintain our words for the US economy, given the Fed's hawkish intentions. In the coming week, we note Fed Chairman Powell's testimony before Congress, while we highlight the release of the US employment report for February on Friday. The pound is about to end the week near the same levels it began against the US dollar and JPY, yet is losing ground against the euro. On a fundamental level, we highlight the agreement made between the EU and the UK. As was expected, UK Prime Minister Sunak with EU Chief von der Leyen sealed a decisive breakthrough in the Brexit agreement regarding Northern Ireland's trading agreements. The Windsor framework would include a lowering of the trade barriers between Northern Ireland and Great Britain. The European Court of Justice still has oversight. Northern Ireland has a veto on new EU laws, and key taxation rules are to be amended, while the approval of the deal is still pending, with Northern Ireland's Unionist Party playing a key role here. On a macroeconomic level, we note that the nationwide house prices growth rate marked another contraction, a result possibly also of BOE's monetary policy tightening. On a monetary policy level, we highlight the comments of BOE Governor Bailey, as he practically stated that the bank may have reached its terminal interest rate, and overall the struggle within BOE's balance of power seems to be shifting slowly but steadily away from the hawkish side, which could weaken the pound. JPY remained relatively unchanged against the US dollar and the pound for the week, and is clearly losing ground against the euro. We note on a macroeconomic level that the preliminary industrial production growth rate suffered a substantial contraction for January, which tends to intensify our worries for Japan's economic outlook. Yet the demand side of the Japanese economy seems to remain robust, thus may continue feeding inflationary pressures, something that was evident in the release of Japan's headline and core CPI rates for January. On a monetary level, we highlight the release of BOJ's interest rate decision on Friday's Asian session. The bank is expected to remain on hold, keeping rates at minus 0.10%, with no surprise being probable. Yet the bank, given the change of leadership it is about to undergo, it's the last meeting before Mr. Ueda and his team take over, may be inclined to surprise the markets. In such a case, we may see BOJ tweaking its ultra-loose monetary policy once again by widening its yield curve control bands, and could provide substantial support for JPY. Yet the base scenario for now is that the bank is to remain substantially dovish in its accompanying statement once again, which could weigh on JPY somewhat. The euro is about to end the week stronger against the US dollar, JPY and GBP in a sign of a broader strength. On a macroeconomic level, we note that the Eurozone's economic sentiment for February failed to improve, while the area's unemployment rate ticked up for January, both being categorized in the negatives for Eurozone's economy. The main release that shook the common currency were the preliminary HICP rates for February. In France, Germany and Spain, we saw an acceleration of inflationary pressures that inevitably prevented Eurozone's headline rate to slow down substantially on a year-on-year level. It's characteristic that the area's preliminary core HICP rate for February, which excludes food and energy prices, accelerated beyond market expectations, reaching new all-time highs. On a monetary level, given the acceleration of the Eurozone's inflationary pressures, we may see ECB's hawkishness sharpen. Statements of ECB officials seem to be locking in a 50 basis points rate hike in the bank's March meeting and tend to foreshadow more 50 basis points rate hikes to come. On the other hand, should the bank proceed with more substantial rate hikes beyond March, we may see the possible adverse effects on Eurozone's economy widening. AUD seems about to edge just a bit higher against the US dollar for the week. On a macroeconomic level, we note that we had some positive news from Australia, as the retail sales growth rate for January accelerated beyond market expectations, showing a strong demand side of the Australian economy. On the other hand, though, we note that the Australian economy grew at a slower pace than expected for Q4, which tends to weigh and may also cause second thoughts among RBA policymakers regarding their hawkish intentions. On the monetary level, we note RBA's interest rate decision on Tuesday's Asian session. The bank had already expressed its intentions for further rate hikes, and the market expects the bank to deliver a 25 basis points rate hike in its next meeting. Should the bank actually deliver the expected rate hike and also maintain a hawkish tone in RBA Governor Lowe's accompanying statement, we may see the bullish effect on AUD intensifying. On a more fundamental level, news from China seem to be pretty good, as China's reopening supports the economic activity of the manufacturing sector. Attention now turns also toward China's National People's Congress annual legislative meeting and any measures that are to be taken to boost the Chinese economy in the current year. The CAD seems about to edge slightly high against the US dollar for the week. On a macroeconomic level, we note that Canada's GDP rate slowed down beyond market expectations for Q4 and on a year-on-year level reached stagnation levels of 0%. The release could enhance BOC's intentions to pause rate hikes. Hence, on the monetary front, we highlight BOC's interest rate decision on Wednesday. The market expects the bank to remain on hold, keeping its rate at 4.5%. Should the bank remain on hold as expected, we may see the market's attention turning towards the accompanying statement. And should the document solidify the market's expectations that the bank has reached its terminal level of interest rates and no more rate hikes are to be expected, we may see the CAD slipping. On a more fundamental level, we also highlight the possible effect that oil prices may have on the loonie. WTI prices for the week seem to be edging higher. On the one hand, markets' anticipation of a widening of economic activity in China is expected to boost oil demand and thus may have a bullish effect on oil prices. On the other hand, though, the US oil market is still characterized by slack and tends to keep oil bulls at bay. Should oil prices get additional support, we may see the loonie benefiting as well. Overall, and as a closing comment, we expect the US dollar to regain some of the initiative over the currencies, given that the frequency and gravity of US releases and events increases. We may see the influence of the greenback being on the rise, yet that may also increase volatility. Nevertheless, there are still a high number of high-impact financial releases stemming from outside the US, which may allow for other currencies to steal the spotlight from the US dollar at certain points during the week, and thus create a more balanced mixture of trading opportunities. At this point, we would like to note that US yields rose substantially over the week, with the 2-year yield surpassing 4.8%, a level not seen since 2007. Should the US yield curve inversion steepen further, we may see the US dollar enjoying further safe haven inflows. US stock markets, on the other hand, seem to remain relatively unchanged for the week. The market worries for possible over-tightening of the Fed's monetary policy remains present and could weigh on US equities. In the coming week, we expect investors to continue to navigate through the Fed's intentions and the earnings releases due out. On the other hand, we have to note that most of the high-profile companies have already released the earnings reports, and the number of earnings reports due out next week as such is expected to be reduced in comparison to the past weeks. Thus, the effect on US stock markets and the general market sentiment is expected to slowly start fading away. As for gold's price, we know that the precious metals price was able to hold the downward motion characterizing it over the past 2 weeks. The negative correlation between gold and the US dollar seems to be maintained despite its disproportionality, yet we highlight the testimony of Fed Chairman Powell before Congress next week, as well as the release of the US employment data for February on Friday as key events for the shiny metals direction. We hope that you found this report useful, and from all of us here at IronFX, best wishes for solid trading.
In our previous video, we talked about various indicators regarding inflation. In this video, we will look at 2 indicators related to employment. The first one is the unemployment rate, which is probably the most widely known labor market indicator. It measures the number of unemployed people as a percentage of the labor force. It is lagging indicator, which means that it generally rises or falls when economic conditions change. When the economy is in bad shape and jobs are scarce, the unemployment rate can be expected to rise. When the economy grows at a healthy rate and there are lots of job vacancies, it can be expected to fall. The second indicator is the non-farm payrolls figure, NFP for short. This is a key indicator used primarily for the US employment market, although it is also used for other countries as well. It measures the change in the number of people employed during the survey's month, excluding the farming industry. Basically, the indicator measures the US employment market's ability to create jobs, which also has an effect on consumer spending. It is released on the first Friday of every month and is very closely watched by investors, as well as the Fed and other US policymakers. If the indicator rises more than market expectation, the US dollar may strengthen and vice versa. Note that the change in this indicator can be very volatile and could create a wider market distortion, as the ripple effects may also be felt in the US stock markets. Thank you for watching.
All right. Okay, let's give it a moment for the others to join first before we begin. Let's wait for others to join first. Okay, let's give it a minute. All right, guys, let's give it a minute while we wait for the others to join first before we begin. Okay, just doing a mic test and video test. Can you guys hear me and see me? because I'm actually using a new setup from home. It's a video setup, it's a new microphone setup. So just wondering if you guys can hear me. Hey, hi there, Amit. Hi there, Steph. Okay, just letting you guys know in case you guys, want to contact me after while we are waiting for the others to join. Okay, let me get this up. Okay, in case you want to contact me after this webinar, want to message me, you guys have any more questions, you can actually contact me via this link. I'll just send it to the chat. You guys can check it out. I've just sent the link to the chat already. Can open it up, take a look at it, and also that's about me. Okay, so also just want to let you guys know there's actually, if you guys want to find out more about webinars like this, you can head on to IronFX website, and then you can head on to Forex webinars. So it's under IronFX School, under webinars. Okay, so you guys can actually scroll down, can actually register for the education. Okay, not sure why my face isn't up here yet. Okay, yeah, my face is not up here yet. Well, it's fine. Okay, next. So we actually have the IronFX VIP room. So please join the room. So I actually will send the link to the chat. You guys can actually deposit money. So once you guys deposit money into the accounts, you guys can actually have free premium services. So for bronze, deposit at least $250, silver at least $1,000, and gold at least $2,000, and you can ask for analysis requests from us. From us, prop traders, indicator requests from us, platinum at least $5,000, diamond at least $15,000. So yeah, just head on here to register this website and then log into client portal, select VIP room, make sure your balance meets the minimum required. So in the room, you can actually have a one-on-one session with us, Jean, this entire group of us. You can talk to Cassandra, Desmond, Jean, Annabelle, Jianing, and myself. You guys can ask us questions directly there. So we are always there on the channel from Monday to Friday. All right. Okay, let me just close it out. Okay. Topic for today will be on the Fibonacci series, 2 out of 4 Fibonacci extensions. Okay. So let me just begin this slideshow. Okay, my name is actually Chen Yongxing. I'm actually the trade analyst for Everest Fortune Group. Hey, hi there, Charles. Just saw you coming in. So I'm actually the trade analyst for Everest Fortune Group. So we are actually the finalists for the best Forex research for 2019, 2020, and 2021. We are also the finalists for the best equity research for 2020 and 2021. So right now we actually have a very, very special collaboration with IronFX, where we are bringing you guys the good stuff, teaching you guys the education that you guys need for your trading needs. So a few topics just to cover for today. We'll be going through the ideal market structure, different Fib retracement levels, Fibonacci extensions. We'll be focusing more on that today. Fibonacci extension, which are Fib levels that are above 100%, which are the Fibonacci extensions. And how do we combine Fibonacci retracements for our trading? Hey, hi there, Fo. Hi there. Okay, so first topic we are going through is the ideal market structure. So in ideal market structure, you guys can actually look at this chart first. You can actually look at this animation first. This is actually a wrong way of drawing a Fibonacci line. So let me just go to the chart to show you guys. Okay, maybe I'll just use the euro-dollar chart on the 1 hour charts. Okay, I'll just clear things out. Okay, so this is actually very, very insignificant. This is actually not clean. The way you're drawing a Fibonacci line, you can actually find the Fibonacci from the top left-hand corner, 1, 2, 3. So it's called the fib retracement. You actually scroll down, it's called the fib retracement is the first option. So a fib retracement, you want something that's very, very clean, where you want to draw it cleanly. So you draw from the top, bottom to the top. So you want to have a significant swing to the highest points. So what is going on? You want the trend line. You can actually see this dotted trend line. It has to be relatively close together along the Fibonacci trend line. Then it's a clean and valid trend line. But what is not valid? If you actually draw a Fibonacci line like that, so let's say I draw it like that. Because as you, okay, I'm not sure why this keep disconnecting. Okay, so if you actually draw from the bottom to the top, but then you notice that the Fibonacci actually deviates very, very far away from this trend line right here. This trend line to the top, it deviates quite far away before it still deviates quite far away. It's not even close to the Fibonacci line before it continues heading up. So this is actually not a clean setup. This is not the way you should be drawing. So what you should be doing is, if you actually draw a fib from the bottom to the top, this is one single. You can actually treat this as a one single Fibonacci drawing, because price went up, respecting that trend line, came back down, tapped within the 78.6% Fibonacci line before price continues moving upwards. So I'm just showing you guys the difference between drawing a clean and unclean Fibonacci points. So next, using a Fibonacci swings the right way. So please take a look at this short little clip. So the swing highs and lows need to be very, very significant before you can start drawing your Fibonacci line. So, so another reason for using the Fibonacci line is because many algorithms actually use Fibonacci for their trading. So it's actually robots, expert indicators. They rely a lot on the Fibonacci line to actually trade. So you can actually expect. So let me just show you guys an example. You guys can actually expect the, okay, maybe I should draw from here to here, because this is a significant swing low to the significant swing high. You'll notice that algorithms, or should I say the 61.8% golden Fibonacci line, usually price comes back down and reacts off very, very strongly on it. You can actually take the 61.8% Fibonacci line as a potential take profit area. Potential take profit area, or if you are looking for longs. So let's say looking at this overall time frame, it's very, very bullish. Price just continue going up. What you can do is you can wait for price to tap into the 61.8% Fibonacci retracement line before you move down. Zoom in at this area to the 5 minutes, 15 minutes, or even the 1 minute time frame for your entries. So potential better entries right there. So that's how you can pull Fibonacci in within your trading. So next, moving on to following the market structure. So we got to follow the market structure. Just now I show you guys the trend line cannot cut through the Fibonacci trend line. So you take a look at this video, price actually cut through it. So it's not clean and it's the wrong way of drawing. So let's watch it one more time before I show you guys an example. Okay, done. Okay, let's take a look. Let me find one more that it's not valid. So maybe move on to the 15 minutes time frame. So let's see. Okay, let me find one. Okay, let's say if you actually want to draw a Fibonacci line from this significant swing high to this significant swing low, if you actually draw the fib from the top to the bottom, is this valid? Well, to answer your question, it's not a valid trend line, because like the video, like the example that I just showed you just now, price actually went through and cuts through the entire Fibonacci trend line before it moves down towards the significance swing low. So this is not a valid way, and it's a totally a wrong way of drawing your Fibonacci line. So what you want to actually do is you can actually draw the Fibonacci line from here, the top, to the bottom. So you notice that price actually comes down to this from the top to the bottoms and then continues. Moving back up, retraces back up to the 78.6% Fibonacci line before it continues back down. So just for display purposes, just to show you guys cleanly, I'll just edit this to 78.6%. So notice price just went down, went up, tapping the area. So this is considered one Fibonacci movement. So you can start to draw the next one. Price goes down to the significance swing low. There's another way you can draw it. So price continues going down. Okay, not sure why it keeps disconnecting. Okay. All Fips. Okay. Next, let me find another one. Let me get back to the question. Following the market structure, I've shown you guys a clean one already. I'll just disconnect that. Let me find a clean market structure for you guys to follow. Want something that's very clean. So maybe I can follow this. This might be pretty clean. It's not that clean. It actually deviates quite a bit far away. So you actually went up. So this is not clean. I wouldn't take it as a clean trend line, as a clean Fibonacci drawing. So let me find another one. So this is actually very, very clean. If you draw from the top to the bottom, you notice that price is more or less very, very close along the Fibonacci trend line. So please screenshot this down, this setting right here. This is my personal settings. This is the Fibonacci settings. So it's when I double click it, it's under style. Please take photo of it. You guys can actually copy it out. These are the settings that I'm actually using for trading. All right. So once you guys have taken photo of this, let me move down. So these are the next settings that I'm actually currently using. Same thing, please screenshot this down and apply it to your trading view. Oh yes, by the way, talking about trading view, let me get this thing out. Okay. So if you guys actually want to, sign up for TradingView, want to upgrade to the premium account or even the pro accounts. So I'm not a spokesperson for TradingView, but I actually find that using the premium, the upgraded TradingView plans, especially the pro plans, which I'm personally using on my personal TradingView accounts. What I like is I can actually use more than 2 indicators. So on pro accounts, you can actually use 5 indicators, 2 charts in one layout, 20 active server-side alerts, which are very, very important to me. Because using the alerts, I can actually not monitor my chart so often. I set an alert, I go and relax, I come back only when price hits my points of interest. And most importantly, it's actually ad-free. So you actually won't see all the advertisements popping up. So I just send the link to the chat. You guys can actually use my referral link to sign up. All right, let us continue. So back to the topic on Fibonacci series. So next, the different Fibonacci retracement levels. Okay. So yeah, by the way, if you guys have any questions so far, feel free to ask in the chat. I will try my very best to answer you. So if I'm going too fast or if I'm going too slow, if there are any things that you guys do not understand, do let me know. Also, please try to implement the Fibonacci using the Fibonacci retracements for your trading. It actually helped me a lot. Last time I did not use Fibonacci retracement for my trading. I did not know where price can potentially head to. I did not understand the concepts of Fibonacci lines. So just now, as I mentioned, drawing from the significance, swing low to the swing high, you actually notice that price actually came back down to this 61.8%. So if you are looking for sales, let's say you are selling, you can actually take profit at this area just in case price bounces all the way back up to your entry. So use that as a potential target point. Hey, hi there, Charles. Hi there, Phoebe. Hi there, Francis. Hi there, Jana. So you guys coming in. All right, next, just having a quick look. Let me find another clean Fibonacci line setup. So this is actually quite clean. Quite clean. Price actually follows accordingly along the trend line, moving upwards. So that's another way that you can actually draw it. So let me find the 127.2%. Okay, so later we'll get right into that. Hey, hi there. Hello, man. Hello. So today we'll be talking about just a quick recap for those who are new here, who just came in. I'm actually going to talk a lot about the Fibonacci extension lines today and how you can implement it into your trading. So it's numbers above the 100% fit, which is the 127.2% and the 161.8% Fibonacci line. Wait, let me get this out. We are mainly focused on this 127.2% and 161.8%. Okay, next, moving on. Ideal market structure, I'll show you guys already. Fibonacci extension. Okay, we'll not be going through that because I'm sure many of you guys are new traders. So if I actually show you guys the Nike tick today, it might actually confuse you guys. So there's actually a trading method called the Nike tick. So you can actually take a look, price. Okay, take a look at this video again. So this is why it's called the Nike tick. It looks like a tick. Draw from the starting points to the end points. And you watch out for the 127.2% area and the 161.8% area. So price actually taps into that area and reverses back down towards the previous overlap support. So that could be a potential trade setup you can actually take a look at. I'll show you guys an example. Hopefully I can find an example. So let's see. So we currently are looking at the 127.2%. You actually notice that price actually reversed back up. So right now we actually want to look for a potential setup that we can take. So if we actually use a Fibonacci projection line, I'll just show you guys today just an example. I'll not expect you guys to understand or use this method by the end of this session. But you can actually use the Fibonacci extension line. Let me find it. Trend-based Fib extension. It's 1, 2, 3. Trend-based Fib extension from the top to bottom and to the next swing. So you are swinging from here, here, and here. So that's how you draw it. You notice that the 78.6% Fibonacci projection line and the 127.2% Fibonacci projection line are kind of intersecting together. You can actually draw a box. Take a look very, very nicely. So in order not to miss your entry, you can actually have a 1 pip entry above. So instead of 1.08344, you enter at 1.08354. So it looks more or less like a sniper entry. 354. You snipe your entry, stop loss at the. Let me get this out. 127.138. Okay. Let me clear it out. Make it clean for you guys. Stop loss below the 141.4% Fibonacci line, and then you aim for price to hit back up towards the previous overlap resistance. Let me get this line out. Resistance line only. Notice that price actually, if we move on to the smaller time frame, price actually went very, very nicely, tapped into our entry, and reversed back up immediately. So this is actually a one-to-one setup, a one-to-one trading setup that you guys can actually take a look at. So yeah, very, very nicely one-to-one trading setup right there. So I'll just screenshot this down and send it to chat so you guys can take a look at it. One-to-one setup right there. Copy link to the chart image, I'll send it to the chat. So that's an example of a reverse Nike tick. So let me show you guys another Nike tick. Instead of buying, you guys will be selling back down. So let me try to find an example for that. Right, give me a moment. Let me find it. So this is quite a clean setup. It didn't hit. It's nowhere close towards the 127.2. I'm looking for price to be potentially close to that. So let me find a setup for it. Okay, potentially we can take a look at it. Look at this. Okay, this might be a setup. Okay, of it. Okay, this is not clean, it's nowhere close. Well, let me find another one. So this setup is actually quite rare, especially on the larger time frame. So it might actually take some time to find it. Let me find it again. Okay, so if price actually, so reverse Nike tick. Price coming back down. Okay, this is quite a nice setup. This is a reverse Nike tick. Price actually hit up and reverse back down. So let me show you guys how I found it. So if you actually draw a Fibonacci projection line from the bottom of the swing low to the top and back down to that, so you can actually see 1, 2, 3. So it's pretty much quite a nice Nike tick right there. So we are looking at the 78.6% Fibonacci line. So I'll just draw that area out. Next, you can actually draw a Fibonacci line, Fibonacci retracement line from the top to the bottom. You notice that the 78.6%, I'll just highlight it out for you guys. So you notice that is 78.6% Fibonacci projection line and the 127.2% Fibonacci extension line are intersecting with each other. So you can actually take a short position right there. Take a short, your take profit will be at the previous swing high right there. So it actually turned into a support level. So that could be a potential trade that you can actually take a look. So for the stop loss instead, actually I noticed that the 141.4% has been hit. You actually notice that your stop loss would have been hit. But actually, if you play around actually through some back tests, we actually notice that the Nike tick setup also works if you set your stop loss to the 148%. 148%. Slightly higher, 148%. It's still a more than 1-to-1 risk to reward trade. So it's actually a 1.32 risk to reward trade. You can actually snipe it, a safer entry, 148% stop loss, where you set your stop loss. So that could be a trade setup. So let me just screenshot it down for you guys to take a look. Copy link chart image. You can take your time to actually look at the forex charts, your markets, find potential setups. Okay, next. Nike tick setup, you actually notice starting points, reversal. So this is actually a way of reversal trading. Okay, combining fib extensions with retracement. Just now I showed you guys already, the Fibonacci lines are intersecting together. That is why we have added confluence to. That's why we have increased confidence for the trade setup right there. Okay, so let me show you guys how I personally trade. I actually use Fibonacci lines a lot for my trading. So if you actually take a look right here, let me find a trade setup. Okay, let me find a potential trade setup. So 61.8%. I always wait for price to retrace back down towards the 61.8% area before I move towards the 1 minute time frame and search for potential entries. So for me, I actually use smart money concepts. I use that a lot for my trading. So the way I actually look at the trade setup is price goes down, goes back up, goes down, goes up, goes down, hits down before it breaks structure before moving higher and higher. So you notice that where is the market structure shift? How it works is a market structure shift is when price forms a higher high before moving higher and higher. So this is our market structure shift right there. You notice that price actually broke the high before retracing back down and moving higher. So this is my 61.8% points of interest. So just take it as this, my 61.8% POI is how I wait for my trade to happen. So in this particular scenario, it's the same thing also. The 61.8% Fibonacci retracement line is right there. So what I do is I wait for price to head back down before we have a market structure shift right here. You notice that price actually broke this high right there. Okay, let me find this. Okay. Price broke structure. I'll just write this out as simply as possible. Price actually broke structure right there before we. Okay, let me put this down. Let me just redraw it out. How I look at it. Okay, so it's the same thing. Price book structure. So you can actually start to look for a retracement by entry. So the moment price break structure, my first entry can potentially be either the, so on the 1 minute time frame, this is the previous significant swing low. So I'll draw it all the way up to the high where the high was. So if you notice that price taps into the, I'm always looking for the 38% area for my entry or the 61.8% area for my entry. So in this particular scenario, price actually came down very, very close towards the 38.2% and Fibonacci retracement, but actually did not activate. So as price continues moving higher, I'll continue moving my Fibonacci line higher and higher, and then potentially I can enter my trade at the 38.2% area. Price actually came up, went back down towards my 38.2% area. That is where my entry would have been. So just let me draw it out. Have an entry right here, 38.2%. Stop loss right below all the way down to that previous swing low. And then I aim all the way up to the next points of interest all the way up in the charts. But the issue with this, how can I refine my entry? So although I say that 38.2% would be a potential entry, so it would be a hit or miss entry. My better entry I would like is preferably the 61.8%, but apparently price did not retrace back down towards that area. So usually what I'll look for is at least the 50% area. Why the 50% area? Because 50% retracements is usually the discounted zone. So you take it as above here. Anything above right here, if you are buying, it's the premium zone. Anything below that, it's the discounted zone. So we always want discounts, especially when we are buying things in real life. So this could be a potential buy entry right there. Buy entry, continue, waiting for price to continue moving up. So it also looks like a sniper entry right there. Stop loss below, so you would have reduced your risk by roughly an estimated, okay, in this particular case, reduced by about 8 pips. Not the best, but it's better, right? Okay, so let me just move on. Okay, I'll just screenshot this down and I'll send it to the chat. So this is how I personally trade for my trading setups. I'll label it out, how I personally trade. Okay. So a potential take profit target, this is where we will be using the Fibonacci extension lines. So anything above 0% is actually, the minus 0.272 and minus 61.8% Fibonacci line. So these are called expansions, which are negative. So let's see, in this particular scenario, we can actually use it as potential take profit targets. Okay, let me turn on the lights. I think it's getting a bit dark. Okay. So with our first take profit target, let me clear this out, 5 minutes. Okay. We can actually aim for the negative 27.2% Fibonacci line for our first take profit target, which also is in line with the previous swing high. So it coordinates very, very nicely. We are adding confluence to why we are taking profit right there. So you can either take partial profit right there, and then your final take profit can potentially be at the negative 61.8% Fibonacci line. Final take profits. So at the partial, when you take partial profits, you can close. So this is just a suggestion. This is not a trade advice. Potentially close. So I write potentially close 80% of your trade. You leave the rest to run. So the final take profit is the remaining 20% of whatever you didn't close. So this is how you can personally manage your trade just by using the Fibonacci expansions and extensions. I'll just delete all this out. All right. I'll screenshot this down. I'll send it to chat. So I'll label it as how you can use Fibonacci expansion lines for potential take profit targets. Okay. Next. Let me find another setup where I can make use of the Fibonacci extension or expansion lines. Okay, well, maybe in this particular setup, okay, it's not the best setup because I do not like this so-called support. Okay, so since you guys are actually using classic support and resistance, most traders are, I'll just use it then. So maybe we can actually take this area as a potential Okay, let me just draw it out, maybe on the 1 minute time frame. I do apologize if I'm dragging the screen a bit too much. Okay. So let's draw our first support area first. So we have a very, very nice support drawn out. Very, very nice. Price draws in. We are drawing the best fit lines. So we actually have 3 tabs. Pretty much this is a valid support area. So very, very nice support. Price came down, tapped right into that again. So what I'm looking for, same thing. I'm looking for a market structure shift. So even a minor high. So let's say price goes down, even a minor high like this gets broken. I also take that into account. But without this, how I take a look at it. So this is also a when price broke structure right there. So once price broke structure, I'll start looking for, as I mentioned, either the 38.2% or the 50% Fibonacci retracements. So I'll draw from the bottom to the top. So in this particular scenario, price actually tapped into the 38.2%. So why I usually talk about 38.2%? Because it's nearly an unmissable area. You nearly can't miss the trade if you actually enter at the 38.2%. So with our entry in place at the 38.2%, stop loss below the previous significant swing low, you start to aim for the. Okay, let me just screenshot first before we continue. This another setup. Okay, I'll screenshot this down, send it to chat first. Okay, I'll show you guys how to use the expansion. So it's the negative 27.2% and the negative 61.8%. So you can actually notice that let's see whether the 61.8% target has been hit. The price actually tapped very, very nicely before it reversed back down. So same thing. Let me get the lines out. Do I have the lines? No. Okay, never mind. Same thing. This could be your potential first take profit target, first TP target. Next, it's your final take profit target. So I'll set this as the final TP target. You notice price taps very, very nicely into the negative 61.8% before it automatically reverses all the way back down. So yeah, I will just screenshot this down and I'll send it to chat. So for this particular trade setup, it's actually a 1 to 1.61 risk to reward. So I'll copy into a chart image, I'll send it to you guys. So this another how you can use another example. I'll just type it out. Another example of implementing negative 61.8% Fibonacci expansion. So I'll just bold this word expansion line. Okay, no problem, man. Juha Kiwi. So you actually scroll through the chats. I actually have sent a few setups, just how to use the Fibonacci lines, Fibonacci expansion, Fibonacci extensions. No problem, man. Okay. So next, let me take a look at another trade setup. So we have to go through a very, very intensive practice session. So you guys can more or less see how to use it properly. So same thing as I drawn, price is very, very close within the Fibonacci trend line. All right, next let's find another setup. So I'll just find another trade setup where we can aim for. Okay. All right, it's quite a nice one. In this particular scenario, price actually went up, we actually have quite a nice resistance right here. Quite a nice resistance, so I'm actually drawing the best fit line. So maybe this is not the best, but yeah, best fit resistance. Extended box rate, this is not the best resistance line, but more or less you guys get it. Price tap, failed to break before, continue going back down. So let's see how we could have potentially entered this nice setup and potentially look for take profit targets. So same thing, I'm looking for a market structure shift. Even a very, very minor one means a lot. Okay, let me take a look. Price actually swung significantly to a top before it broke structure right there. So we actually have a market structure shift right there. So even on the 1 minute time frame, this one is quite a significant structure. It takes quite a bit of practice before you can start to spot all these kind of structures taking place. Okay, let's move on. Okay, let me just draw it out nicely, very, very clear for you guys to see. So this is how I actually see it. Okay, let me find a nice place to put it. All right. So same thing, we have a market structure shift here. So I'll just put an X right there, bottom right, make it bold. So you guys can actually see it very, very clearly. Same thing, I'm looking for the 38.2% retracement. So I'll be drawing the Fibonacci line from the top to the bottom, swing low. So I'll be drawing every time price, every time price increases, I'll just be adding my entry right there. So notice the 38.2% area, that would be my entry. So I'll be entering right there. So the moment price steps in, stop loss above at the previous swing high. Take profit target, your first take profit target can be the negative 27.2% Fibonacci line. Same thing, this is your first take profit target. Your next take profit target is the negative 61.8% Fibonacci line. This is the negative, this is the final TP target that you guys can take a look at. So I'll just screenshot this down and send it to the chat. Okay, maybe I should label this out. This is a very, very nice classic resistance area. Okay, I'll just screenshot this down. Okay, I'll just screenshot this down nicely and send it to the chat. So this is another example on the use of Fibonacci expansion lines for your take profit targets. All right, any questions so far? Feel free to let me know. So I'm always aiming for the 38.2%. Any questions, just let me know in the chat. I'll slow down. If you guys have any questions, just let me know. Okay, let me take a look at this setup right there. Okay. Let me find another setup. So I haven't found an extension setup yet. Let me find it. Okay, so we actually have an extension setup. Let me find it. Okay, let's move back. Let me just move back to that setup. Just now I had it right there. Hey, where is that setup? Okay, it's okay. Okay, just now I show you guys this setup. I already showed you guys just now. So we had a market structure shift here. Price actually entered. X right there. Price came back down, tapping into the 38.2% area, but I told you guys you can expand your entry to 50% area. So how do we use the extension, Fibonacci extension line now? Can you draw the fib from the bottom of the swing low to the next high? Draw it out. Wait, my bad. Draw it out from here to here, the top to the bottom, where price last hits, and then you start to draw the 127 and 161.8% area. So these plus sides are actually the positive numbers are actually the Fibonacci extension areas. So if we actually add, so maybe you can add some confluence, negative 27.2 and negative 61.8. Okay, these are quite far apart. Well, you can actually use the extensions for your take profit targets also. So if you actually found another long entry, let's say you found another long entry, let me find one. Price goes down, retraces back into the 61.8%. So let's say you actually caught some kind of entry. So this is an unrealistic setup right there. So let's say you actually caught an entry right here, 61.8%, stop loss below, can aim for the 127.2% Fibonacci extension line, or the 161.8% Fibonacci extension line. Okay, I'll just screenshot this down and I'll send it to the chat. Copy link to chart image, send it over. So yeah, any questions so far? I think you guys have no questions. You guys are just understanding, watching, slowly understanding what is going on. All right. So let me find the Linktree link. Linktree.me/. So you guys want to contact me. You guys want to let me find it. It is actually my personal account. You guys can actually follow me. This is my personal Instagram account. You guys can follow me. My account is not private. Feel free to follow me and ask me, talk to me there if you guys want to. So you guys can find out more about me via this Linktree. So I'll send the link over to the chat. You guys can click on it. It will expand out. It's like my portfolio easily it's like my portfolio, label it out nicely for you guys to take a look. All right. So far, any questions before I end this webinar? Just let me know. So I know this might not be the easiest of topics, especially for beginners. Many traders actually did not use the Fibonacci lines when they start trading. So please do not make the same mistake. So let me just take a look at EU. I'm honestly looking to, just sharing a bit, I'm actually looking to continue selling EU, possibly selling EU just because there's this nice little support area that I'm looking for price to head towards. So it's actually a nice area on the 1 hour chart that I'm looking for price to hit. So you actually notice that there's a trend line. So we actually have 1 tap, 2 taps, 3 taps, 4 taps, 5 taps. So if price actually manages to come back down towards this area, I'm looking for retest before price hits back down. So this could be a potential setup that I'm actually looking at currently for euro dollar. Potential trade setup for euro USD. Okay. So currently, if there are no further questions, I'll be ending this webinar for today. So yeah, thank you guys for joining. Appreciate it. I'll see you guys in the next webinar. So yeah, thank you Phoebe, thank you Jana, thank you Joha, thank you OK Chukwu, Thank you, Samuel, Julian. Thank you, Tivin. So yeah, thank you everyone for joining. Feel free to talk to me within the, where is it? The VIP trading room. Just ask me any questions there. Let me know. No problem, no problem. See you guys again. Hey, bye Jana, bye Tivin, bye Joha. Bye guys, take care. Safe trading. All right. Hey, bye guys, bye guys. I'll just end it right here.